The next ratio we are looking at is the debt-to-equity ratio. This is something a creditor would look at to see if Lou's credit is trustworthy and how regular he is with his payment of loan installments. They could look at his company's debt-to-equity ratio. This ratio compares a company's total debt to total equity to see how much debt is present in comparison to the amount of equity. This is a good indicator for banks and lenders to see how much risk an owner is bearing versus external creditors. The debt-to-equity calculation is just as easy as the current ratio calculation. You take the company's total liabilities, what it owes to others, and divide it by equity. For example, if Lou's business owes $2,736 to debtors and has $2,457 in shareholder equity, the debt-to-equity ratio is 1.11. Let's look at an example using a simple balance sheet. In this example, you can calculate the debt-equity ratio by using the formula $120,000 divided by $200,000. This formula returns the debt-equity ratio of 0.6. Therefore, this company's long-term debt equals 0.6 or 60% of its owner's equity.